Está al aire. Saludos. Saludos.
Hola a todos, ¿cómo están? Muchas gracias por conectarse a este webinar. Estamos con Florencia Stambuk, encargada de distribución. Bienvenido.
Hola a todos, gracias José. Bueno, como comentó José, mi nombre es Florencia Stambuk, estoy encargada de distribución institucional en la GF BTG Pactual y queremos agradecerles hoy día por estar junto a nosotros para presentarles el fondo de Hamilton Lane GPA. Para partir, queremos comentarles que este fondo partió en mayo del 2019 y tiene la característica de ser Evergreen, lo que significa que es un fondo sin vencimiento, el cual se mantendrá abierto para aportes con entradas mensuales directamente a través de BTG y también directamente a través de otras corredoras gracias a nuestra arquitectura abierta. Hoy en día, el fondo tiene un tamaño de 1,9 billones de dólares y ha rentado más de un 15% anual históricamente. Junto a esto, también agradecerle a quienes están hoy día junto a nosotros, que está Mike Bryan, quien es el Head de Portafolios Evergreen de Hamilton Lane, y Salvador Almeida, que es Head de Business Development en LatAm Hamilton Lane. Y además también, bueno, gracias a José, que es Miguel Correa, que es el Head de Activos Alternativos de BTG Pactual y Portafolio Manager de nuestro feeder. Así que con eso, José, te doy la palabra por si quieres hacer una introducción a nuestro feeder.
En esa línea creemos que hay algunos temas que son súper relevantes y que sin duda están buscando gran parte de los clientes, no solamente los retail, los institucionales, sino que también wealth management, etc. En esa línea creemos que la demanda por activo alternativo sigue súper fuerte en busca de una mayor rentabilidad. Creemos que la liquidez también es un atributo súper relevante y sin duda buscado por la mayor parte de los inversionistas. Y también creemos que la simplicidad operativa, la manera en la cual uno invierte, está siendo cada vez más relevante. Creemos que los inversionistas ya están un poco cansados de los típicos fondos de activos alternativos con promesas tradicionales, periodos de inversión largos y periodos de desinversión en los cuales uno pierde un poco la visibilidad y se hace más difícil la planificación del portafolio de inversiones. Entonces, en esa línea, nosotros hemos hecho una alianza con Hamilton Lane en torno a un fondo que, como decía Florencia, creemos que reúne estos atributos y varios más. En esa línea nosotros levantamos un feeder local en enero de este año, el cual tiene un patrimonio cercano a los 9 millones de dólares, que da acceso a todo tipo de inversionistas a este portafolio global diversificado gestionado por Hamilton Lane. Es un fondo que tiene un track record súper interesante, sobre 15% anualizado neto en dólares, y que da acceso a los clientes de todo tipo, sin importar el monto invertido, a invertir como los inversionistas institucionales a nivel global, en un fondo multiestrategia, tan diversificado como se puede estar en regiones, por gestor y por todos los atributos que uno pudiera pensar empaquetado en un vehículo domiciliado en Luxemburgo y en dólares. Entonces, con esa introducción, le doy el pase a Mike y a Salvador para que entren en detalle en la estrategia.
I'm the portfolio manager of the fund. If you'll permit me, I'll stay in English. I think you'll all thank me very much for not trying to speak Portuguese or Spanish. And we'll present this fund that we've been very excited about building over the last several years. In short, the Hamilton Lane Global Private Assets Fund, we call it GPA for short. It's a portfolio of private equity and private credit assets that we have invested over the last 3 years in the same transactions as Hamilton Lane's traditional locked up funds for institutions. But we've structured this in a way that's more flexible than the traditional 10-year locked up private equity structures, the way most of the industry is run. And so in this fund, investors, both individual high net worth investors as well as institutions, can buy into a fully built out portfolio on a monthly basis And while these are long-term assets, we do offer monthly redemptions with some restrictions. So if an investor's needs change, if they need to rebalance, if they're changing strategy, there's some ability to do that. You're not locked up for 10 years. Today, this fund is nearly 3 years old. We have over $2 billion in assets. It's important to point out that this monthly subscription, limited redemption, this is not the way that most private equity is structured. But we're able to do it because of our global platform and because of our experience managing customized portfolios for investors. With that, I'll pass it over to my colleague Salvador for him to introduce our firm and our capabilities.
Thank you very much, Mike, and thank you very much, BTG, for this partnership. As you know, we've been in the Chilean market for some time now, for over 10 years. We have expanded our presence through the clients that we much thank for the trust in our platform, and now we want to continue that expansion through the high net worth channels, family office, and through this partnership that we have with BTG. I would only take the note that there was a hard process in terms of due diligence by BTG's team to approve this fund, and now that we're on the platform with a local feeder fund, as Jose mentioned, we are very happy and available to attend any question. And so with that, I'll touch here, share some slides, and mainly go to who is Hamilton Lane. And so on a very short snapshot, Hamilton Lane has been acting in the private markets for over 30 years now. We only do private markets, and 30 years, as you can see, has gone by really fast, but at the same time, there's a lot of experience embedded into these 30 years. You have the cycles, you have the dot-com bubble, you have the great financial crisis, you have the COVID impact, and you have a very cohesive team that has very low turnover, and the senior management understands what is going in the markets, has a good read of the market, and we believe that that is part of our success. Today, we have 850 billion of asset under management and supervision, and we deployed in 2021 alone 37 billion into the private markets globally. That makes us one of the largest, if not the largest, allocator of capital in the private markets worldwide, and brings a lot of influence to the market, as that influence creates a good space for us to access deals, as you will see throughout the presentation. We typically like to put our money where our mouth is, and by saying that, today we have over $500 million alongside our clients into our products, into our solutions that we're offering, such as the Global Private Assets Fund. We have over 500 employees across the world with 19 offices globally. To the next slide, a little bit here of our deal flow, what we cover in the market. We really believe that we cover all the spectrum of the market, and even though that you will not have the primary strategy, so the investment in funds in this product here, Global Private Assets, it's very important for our platform because we deploy a lot of capital into the funds, and that's how we create the relationships, and we create the deal flow on the secondary market and on the direct investments. The direct investments can be both on equity and or credit that we have exposure in this Evergreen platform. And so if you can see, in the primary space, we deployed around $30 billion, and then you see secondary $3.3 billion, and direct investments $40 billion. This speaks a lot of the relationships that we developed. Here on the right-hand side, you can see a number of funds of GPs that are very well known. We have much more relationships, but it's important to see that not only the names, but being in the market for 30 years, we are creating these relationships for a long time. And so there's a matter of trust, there's a matter of alignment, and overall, there's a matter of Hamilton Lane will always be here in the private market. So these GPs tend to want to work with us, to like to work with us, because that's everything we do on behalf of our clients, is invest our capital into the private markets. And so throughout the book, we will now pass it back to Mike. You will see how we leverage our platform and how we created a very good solution that needs our deal flow to exist. So back to you, Mike.
Great. So I'll hop ahead to slide 7, perhaps, in the presentation, if you're able to bring that up or not. The key thing around the private markets, the institutions have been investing in this area for decades, and they have done very well in their investments in private equity, right? They have outperformed traditional listed equity markets by 300 to 500 basis points on an annual basis. And when you compound that across decades, it makes a very real difference in the outcomes that investors are able to achieve. Of course, investing in the private markets, it's not as simple as going on the listed markets. An investor has to go out and find these companies, has to create an opportunity to invest. And typically in our world, these transactions are led by a lead investor called a general partner, or GP. And this GP becomes the largest shareholder and can drive the strategy of the company. These GPs are in the business of building assets that somebody else will want to buy in 3 to 5 years. That's their whole model. And it turns out if you build a company with a view towards selling it in 3 to 5 years, it really makes you focus in the right places. What can I do today? What new investments can I make that the next buyer will want to see in this company in 3 to 5 years? And of course, once you've built that strong business, the GP has to find a buyer willing to pay the most, whether that is an IPO onto the listed markets, whether it's a strategic sale, or whether there's another financial sponsor that comes on and steps into their place. And this is really key to how private equity has been able to achieve this outperformance historically. If you look at the next slide, we see that not only are the opportunities for the lead investor there to add value in the private markets, but there are also just more investment targets than there are in the listed space. Here, we look at data from a number of different geographies, and you see, depending upon where you are, between 85 and 95% of the investable companies with over $100 million in revenue are actually in the private markets. And it's just 5 to 15% that are actually in the listed space. And so while we've seen it, advantages of investing obviously in listed companies, you can do so at low cost. It's very hard to achieve alpha, as we've seen in the listed markets, whereas the opportunity set is much richer in the private markets. As we flip this ahead to slide 13, we can see that, on slide 11, we can see this one right here, slide 11. We can see that while there are certainly advantages to investing in the private markets, historically, pension plans and big institutions have had to lock capital up for 10 years in order to achieve this advantage. And what you see here is that the cash flows go into a fund, the negative numbers on the light blue bars, over a 4-year period, and then they're locked up until the general partner sells the company and returns capital to investors. Not only that, the returns can often be negative in a traditional private equity fund, a so-called J-curve, as an investor is paying fees on a large commitment, but it's not fully put to work and the companies haven't started to develop yet. So what we're trying to do is to get all of the advantages that we see in private market investments, but to do it in a structure that is more flexible, is more friendly to smaller institutions as well as wealthy families. And if we flip ahead onto page 13, you can see what we're trying to solve for in the Global Private Assets Fund. So unlike taking 3 to 4 years to be put to work, you can buy into this fund at the end of the month and get access to a fully built out private markets portfolio. Unlike a traditional fund where you might have to send capital in at unpredictable intervals over the investment period, there's no follow-on capital calls in our fund. We manage all that liquidity for you inside of the vehicle. And if for one reason or another your strategy changes and you need to rebalance out of this fund a few years down the road, we do offer limited liquidity. You're not locked up for the full 10 to 12 years like a traditional fund. All at the same time, you enjoy the benefits of diversification, you enjoy the benefits of Hamilton Lane's platform, the same way that large institutions have for decades. Now, what we realize as we put this fund together 3 years ago is that managing a vehicle like this with monthly liquidity involves a lot of different aspects than what people are used to with those 10-year locked up funds. Not only do you need to have great deal flow, but you need to know how to manage a balance sheet. You need to know how to keep it dynamically deployed. And you need to have a lot of a choice in terms of how you deploy this. And if you look at the next slide on page 14, you can see a snapshot of the returns and the fund that we've built today. The fund, as it sits, is nearly 3 years old, and it's actually tracking above our targeted returns of 10 to 12% net. You see, we've been 15% annualized net to date. Not only that, we've been able to do this with lower volatility than we've seen in the public equity markets. As I mentioned, you buy into this portfolio today, you get a fully built out private markets portfolio, over 130 transactions, diversified across strategy, sector, and importantly, with some of the best general partners in the world that Hamilton Lane deals with. Now, for some investors, particularly on the smaller end, if they're putting 50,000, 100,000 into the fund, they may view this as their only exposure to private markets. On the larger end, we have many institutions or even billionaire families that have come into the fund, and they treat this as a portion of their overall allocation. They like that they can get exposure today, that they're benefiting from Hamilton Lane's best ideas around the world, and then they go off and they make targeted investments in those 10-year locked up funds to complement what they have in GPA. Let me step forward onto page 15 and we'll talk about how we're able to build this and how we're able to manage it and how it benefits from Hamilton Lane's platform. So again, most of the allocations in the private markets are in these 10-year locked up funds. And while Hamilton Lane does that for many of our institutional clients, in this vehicle, we are not going into those full 10-year locked up vehicles where you pay full fees in a very expensive way. What we are doing is investing directly into the private companies alongside of our lead general partner relationships, as well as buying pools of assets that have already been invested in here. The commonality here is rather than waiting for 3 to 4 years to get those vehicles invested, when we buy these assets, they're almost entirely in the ground the day that we close in the transaction, and they are shorter duration. So money comes back off these investments after 2 to 5 years instead of being locked up for 10. And that allows us to offer the limited redemptions in this vehicle. Now, on the direct equity side, importantly, if we're investing directly into the underlying company, we're not paying the full management fee and carry that we would if we were going into that general partners fund. And on the direct credit side, we get the benefits of seniority in the capital structure, stability in terms of payment of coupon, and a shorter duration that helps in a vehicle like this. On the secondary side, again, this may be a less familiar area for some, we are buying into an existing stake, another investor's stake in a 10-year locked up fund. So if someone committed to this fund 5 years ago, they have a change of strategy. There's a limited number of groups like Hamilton Lane who can purchase this interest from that investor and take over their position. The benefits for us and for our fund, not only do we get to fully deploy that capital, but there's a shorter hold period since we're coming in halfway through those investments' life. We're often able to buy these assets at a discount to where the lead general partner has them marked. And that can help us to build our fund without a J curve for our investors. And we get the diversification and shorter duration of these assets. Now, as I hop forward to page 18, we can look at how this comes together into the fund today. You see a snapshot of the mix of assets. So you see in the top left a mix of direct equity, private credit, and secondary assets that allow us to keep our fund fully invested, to keep it spread across duration as well as by strategy. Here we have about 2/3 of the portfolio in traditional buyout funds where we see the most stable outperformance of the listed equity markets. But importantly, we also have an allocation to private credit and some to venture capital and growth. This mimics the strategy of a lot of leading institutions as they put portfolios to work in the private markets. It is a global portfolio. In our universe, since the largest private markets are in North America, we see that around 60 to 65% in North America. But we also have a very meaningful allocation to Western Europe, to developed markets in Asia, and into other countries around the world. And we've built this diversified across strategy so that it can be an investor's only exposure in the private markets. Now, how are we able to do this? It really gets back to